FT. Lead article, IMF warns Eurozone on capital flight woes. They're quoting, the IMF published a report, the Global Financial Stability Report, GFSR for the cognoscenti, which warns that Eurozone is a big danger to world financial stability at the moment. So here they're quoting that report. Delays in resolving the crisis meant that unless Eurozone officials stepped up their policy response, European banks would dump $2.8 trillion of assets, more than 7% of their balance sheets by the end of next year. Banks in the periphery would shed just short of 16% of their assets. Sorry, maybe that's 10%. Yep, 10% of their assets. There's more to this. If you look inside, there's loaning and groaning on the back. They actually have some graphs and charts here, which they say come from the Global Financial Stability Report. But one of them, I read it and it didn't seem like it could possibly be right. So I went and I looked at and in fact, they mislabeled the diagram. So this is the thing that senior thesis students, pay attention to the details, okay? So these are the correct diagrams that the FT wrongly reproduces. They get an F today for accuracy in journalism. And so I want to talk about some of those diagrams in a minute, but let me just tell you what's going on, because there's some lessons there for banking. So what's going on is basically this, okay? There's the banks in the periphery of Europe, and that means Spain, Italy, Portugal, Ireland, okay? And there's banks in the core of Europe. Okay. And what's going on is that people are withdrawing their deposits from the periphery. They're worried about those banks, that they may go bankrupt, or there may be a break apart of Europe, and you wind up with a liability of the Irish central bank, and you don't want that. You want a liability of the German central bank. So they're subtracting deposits here and adding them here. They're moving their money from the periphery to the core. Now we know, because we did the payment system, that this involves a movement of reserves or a borrowing back of reserves. Okay, and there is a borrowing back. There's these thing called target 2 balances that are happening at the level of the central banks. But I don't want to talk about that right now. I want to talk about the effect on the banks themselves. If you're losing these deposits, okay, there's a big pressure for you to find some other source of funding, replace them with wholesale funding. That's not going to happen. Or to shrink something on your on this side of the balance sheet. Okay? So what they're doing, the periphery, is shedding securities, shedding loans. Okay? And they're also trying to raise capital. You can see how all three of these things, plus capital, could replace the deposits. You can see how shedding securities could replace the deposits, because it's got to add up. It's a balance sheet, right? Both sides have to add up. And what you're seeing up there in this diagram is the facts of the matter. Here, they're saying that the leverage ratio of European banks as a whole, all of them, okay, has gone down from about 25 to 23. The leverage ratio means total liabilities to capital. Okay, banks are pretty highly leveraged. They typically have 3 or 4% capital, so that's what you're looking at there. And how did they achieve this reduction in leverage? Some of it was by capital, some of it was by selling securities, and some of it was by getting rid of loans. Banks like this that are doing this, not only are they selling securities, getting rid of loans, of course they're not lending. They're not doing any new lending, right? This is not a bank that is serving the manufacturing sector or something like that. They're not about to make new loans, okay? And the core is maybe acquiring securities or something else. Here. In Europe, it's a very what we care about, of course, is not so. This is all Europe average, okay? This diagram, which is the one they mislabel, interestingly, I think there's a sort of Freudian slip going on in the FT there. This one is showing you the difference between the periphery and the core. And you see there's the periphery, the red line, okay? Euro area bank credit to the non-bank private sector. So that's loans, okay? So they're saying, you're seeing here that there's a shrinkage of credit in the periphery. A shrinkage, that's what we're seeing here, okay? And meanwhile, in the core, it continues to grow. But the average, which is this middle one, it just seems flattened out. So there's big differences in the core and the periphery that are going on, that are obscured in this sort of diagram here, okay, that averages across all European banks, okay? So here's a great example of where a little balance sheets go a long way. That if you can translate what you're seeing in the FT into this, you have an understanding of what's happening in Europe and where the tensions are. And this is a segue into this topic for today. It also refers to Draghi's plan to buy sovereign debt. It says, the IMF said that the European Central Bank's pledge to buy government debt if countries agreed to reform plans had lowered sovereign bond yields, but said it was too early to tell whether the scheme would relieve deleveraging pressures. These are the deleveraging pressures we're talking about, okay? The question is, how is it, the question that we all want to start with and we're going to answer today, is how is it that the central bank's pledge to buy government debt, okay, lowers sovereign bond yields? They're just promising, they're not buying any yet. How does that actually affect prices?